You're with Chinchu. Today's point of discussion is about investment appraisal, which is a very crucial topic of almost all the commerce related professional courses like CA, CMA, ACCA, CPA, etc. etc. So let's get into a little bit basics and details of this topic. What is investment appraisal? It is a technique or a methodology used by the management in an organization to decide to invest in which projects. Say for example, they have various investment options or n number of projects, project A, B, C, D, F. Okay? If you have 5 projects in hand, you will be confused which one is the most profitable, or investing in which project will make the company rise more in terms of wealth, profits, cash flows, etc. So, this is a method used aptly to decide. We can actually classify these techniques widely into 2 sets. The first set, which contains or evaluates the time value of money, such as NPV, IRR, MIRR, etc. The second set of techniques are the ones which do not consider time value of money, such as payback period, ARR, etc. What is NPV? NPV is net present value. The simple equation, then I'll explain the logic behind it, okay? The equation is that discounted cash inflow minus discounted cash outflow. The figure we get is net present value, which means what we are calculating here is in terms of cash flows, we are deciding investing in a particular project A is beneficial to the company or not. Okay, as of now, maybe I have spent like 10,000 rupees as of today. I have invested in the project, which is cash outflow. I'm losing the money out of my hands. It is cash outflow. Okay? Due to investing that 10,000 in project A, I might receive cash inflows of 5,000 for the next coming 10 years. Considering the time value of money, that is the reason. Time value of money, what does it mean? The value of 1 rupee today is definitely going to be more than the same 1 rupee tomorrow, or maybe after 1 year due to inflation, due to interest rate, and due to many other factors. Considering this time value of money, we are considering discounting factor. Alright, the discounting factor to discount this 5,000 rupees which I told that we will be receiving for the next upcoming 10 years. So all those cash inflows we will be receiving after year 1, at the end of year 2, at the end of year 3. All these cash inflows are going to be discounted to find the value, the combined value of all those cash inflows as of today, to decide whether investing in today's money, investing that amount today is worth or not. And if discounted cash inflow minus discounted cash outflow is 0, what does that mean? No profit, no loss. How is the decision made? Based on the NPV. If the NPV is positive, it indicates that we are able to make more money than what we have invested in that project. So definitely that's going to be an yes for that particular project. And if the NPV is negative, we won't invest in that particular project. That's how NPV works. The second technique or the method is IRR. What does that mean? Internal rate of return. It is kind of a percentage. We are calculating in terms of a percentage wherein we are deciding whether to invest in a project or not. I'll tell you with an example. Say for example, IRR of project A is 10%. What does that mean? At 10% IRR rate, the NPV is going to be 0. NPV is 0, what does that mean? 0 profit, 0 loss. Simple as that. So, how do we decide in terms of our investment decisions? Say for example, I have 4 projects A, B, C and D in front of me. I have a bunch of money and now I'm confused whether to invest in A, B or C. Alright. What I'll be doing using this technique of IRR, I'll calculate IRR of each of these 4 projects. IRR of first project A is 15%, second is 10%, third is 18%. Okay. Now I'll calculate the cost of capital of the company. So the cost of capital of my company is 15%. Then how will I decide? Any project which comes with IRR of 15 or more, I'll choose to invest in that. Any project which comes with an IRR rate of less than 15%, I will not choose. Say for example, in case of project A, if the IRR percentage was 10% and my cost of capital, which is actually my cost, is going to be 15%. Use your simple logic. If our cost of the capital means our cost is 15% and what I'm getting by investing in project A is just 10%, that's kind of a loss, right? So definitely I will not choose to invest in that project. So wherever the cost of capital is going less or IRR of a particular project is more than the cost of capital's percentage, I'll choose to invest in that particular project. The next technique is payback period. What exactly payback period means? The time period, the actual time period which is being taken to recover the money we have actually spent in a project. Say for example, today, as of today, I have spent like 1 lakh Indian rupees in a project A and a project B, 1 lakh each, okay, project A and project B. From project A, I am able to recover the money in 5 years. And in project B, I am able to recover the same amount of 1 lakh which I invested into that project, which is my cash outflow. It took around 10 years. That is payback period. Payback period is a time period which is actually taken to recover the money we have invested in a particular project. Okay. In the project A scenario, I could recover the money very fast in like 5 years. The next project took me around 10 years. When the time period to recover our money is longer, our risk is increasing. There is a higher risk. And when we are able to recover the same amount of money very quickly, our risk is much lower. So when the payback period is less, it's good for us. The risk is less and we will choose the project with the lesser payback period. There are various other methods and techniques such as sensitivity analysis, simulation, etc., which we will be discussing in the upcoming video. I'll keep you updated. Don't forget to subscribe my channel. I'll be uploading a lot of informative other videos very often. See you in the next video. Till then, take care. Bye-bye.